You will check May 2024. That was question 4. Question 4. Then you check May 2023. That was question 3. All these ones were computations, calculation. Even here, it's calculation. Even here, it's calculation. Then we have June. We have June 2022. Question 2. Question 2, Roman 2. It was also calculation. Then you have November. You have November 2023. Question 2. It was basically what? Theory. Here it was theory. Then you have March 2022. Question 5. This one was also theory. Still, when you check May 2020, August 2025, that was the theory. That was theory about interest rate, futures, options, okay, and other theory things. So at least you see that this area is a bit common. It doesn't mean that they don't ask other areas, but we need to master. We need to master this. Now, I will not discuss this. This is already discussed on the channel. You will find this session. Okay, this one I discussed it. So after discussing it today, you visit maybe and know more about May 2020, May 2023. Okay, so this interest rate, features. What is it all about? Interest rate feature. This is basically this is a standardized contract. This is a standardized contract traded on an exchange, where two parties agree to buy or sell a debt instrument. You agree to buy or sell a debt instrument. It could be like the treasury bills. It could be like the bonds and any other interest-bearing instrument. Maybe you may find like for you're dealing with another instrument that involves the interest. As long as that instrument involves the interest, it can also be part of debt instrument. So it's a standardized contract traded on an exchange where two parties agree to buy or sell a debt instrument at a future date. You agree to buy that at a future date for a price agreed upon today. So you agree now. Okay. So basically that is the definition for interest rate features.
Yeah.
Confirm whether you can hear me. All right. Now, every time you're talking about interest rate, remember you may be a borrower or you may be an investor. Okay, You may be a borrower or an investor. Your worry, you as a borrower, it could be that you're worried about the interest rate increasing. That's your worry. Your worry is about interest rate increasing, because if the interest rate increases, then you are highly likely to pay more what? More money. So you enter into these agreements so that you can mitigate that risk. You minimize on the costs. If the interest rate rise, for you, you will be covered by the contract. Okay? Then if you are an investor, your worry is about what? If you are an investor, your worry is about interest rate falling, okay, or decreasing. Because for you as an investor, your aim is always to maximize the income. So your worry is about the interest rate falling, or decreasing. Just imagine that you're offering a loan. And at a certain point, you realize that the interest rate has fallen down. So in that scenario, you lose what? You lose income. So you protect yourself by capping the interest rate. Okay? So you protect yourself by entering into these arrangements. You protect yourself by entering into this arrangement. Now, colleagues, try as much as possible. Try as much as possible to know the merits and demerits. Try as much as possible to know the merits and demerits. Just maybe to give you a highlight about merits and demerits, because you need to know. You see, these days they put those theory things. You need to know the merits. If you're to use the interest rate features, how does it benefit you, and what are the demerits? Okay, one of the things is that here you're talking about standardization. You're talking about a standardization. It's something that you need the. Am I recording? Okay, so take note that here features. Take note that features are traded on unorganized exchanges. And what does that one mean? It means that this one there will be transparency in terms of the prices. Features are traded on organized exchanges, which ensures that there is transparency. Okay, which show that there is which show that features are traded on organized exchanges, which indicates that there is transparency. There is transparent pricing and standardized contracts. Now you realize that when you're talking about features, you have March features, you have June features, you have September features, you have December features. All those ones are what? Are standardized. All those ones are standardized. And it gives you a picture. What is the price of the March features? What is the price of the June features? And of course, they quote the contracts. You saw that you can easily know the number of contracts you can buy. So it's something that you need to know. Standardization. it brings transparency in terms of the price, and you can easily know the number of contracts you can buy. It also you look at when it comes to liquidity, it means that high trading volumes makes them easier, easier to buy or sell anytime. You can buy in large what? You can buy or sell in large volumes. So high trading volumes makes them easy to buy, or sell anytime, and this ensuring that ensuring quick adjustments to hedges. So it's also something that is better. I also look at the low counterparty risk. The low counterparty, it's a very key point. The low counterparty risk, very key point. Why we are involving here the clearing house. The clearing house guarantees because you're trading on exchange. So it means that these clearing houses will ensure that will guarantee the trade. And this one reduces the what? Reduces the risk of default. Reduces the risk of default by either party. So here the risk of defaulting is minimal. Because you are trading on an exchange. This clearing house will ensure that at least the trade can go ahead and happen. We have already talked about the price transparency because prices are quoted. Prices are quoted, and it helps you as a firm to monitor the market expectation of the future interest rate changes. It is easier to enter and exit as well. It's another point you can put. It is easy to enter. It is easy to enter or exit. What does that one mean? Yeah, you can close at any time before maturity. And that one allows really it's a bit flexible. But also another point you can look at, then there is no upfront. When you're talking about options, you pay some money at the start. But with futures, there is no upfront. This is a very key point. There is no upfront premium that you're going to pay. Unlike options where you pay premiums at the start, here you only deposit the margins. Here you only deposit margins, which are a bit cheaper than the premiums. So a bit at least this one is a bit cheaper compared to premiums. When you're talking about options, this point is there. One of the disadvantages or the merits of option, you talk about this. You have to pay premiums, which is a bit expensive. And as well, this one will help you in terms of benchmarking. If it is effective for benchmark rates, you can easily predict. It's perfect for hedging exposure linked to treasury bills. Something like that, because here you will be looking at what the market offers, and what you can easily charge, what the market offers and what you can charge. So you can easily relate and see how to adjust accordingly. How to adjust accordingly. I will also, maybe the last one, it is suitable for speculative risk management. How firms can use features to take a view on the rates without holding the underlying assets. I can, even if I have not bought the asset, I can look at what the market is offering. Then I predict what is going to happen, maybe in June, because I can look at the June contract and I see the price quoted. Then I can as well predict the rates accordingly. So you add other points, colleagues. You add other points. Like the road transaction costs. It is also one of the points, because here you will not incur a lot of money in terms of brokers, looking for brokers and all that. Those ones you will not incur that. So the merits, just to also summarize on the merits. One, you look at what? There is a basis risk. Here I am going to explain this in details, one of the sessions that we are going to conduct. But basis risks happen in a scenario where you're looking at the futures price. This futures price may not perfectly move with the actual loan rates. So you may predict that maybe the future price is going to be high compared to the actual rate, but in actual sense, you see that what you predicted is not the way it is. Probably you are saying that let me enter into this arrangement. Because the price is highly likely to increase. But you find that in actual sense, by the time you transact, things have not moved in that very direction. So basis risk is always know that is basically a risk. Basis risk is a risk. Basis risk is a risk that the value of a hedge, or the derivative position will not move in the perfect correlation with the asset being hedged. So that is basically the definition of a basis risk. It's the risk that your derivative position, your derivative position or hedge position will not move in the perfect information which you predicted. So basis risk, this one was asked in May 2024. What is a basis risk? When you check in the May 2024 paper, you'll find the examiner asked about the basis risk. So, and basically, this is the reason because you're looking at the future prices with the actual rates. You are predicting that the future price may be high, or the actual run rate may be high. But you find that, okay, you're saying that the future prices, let me put it at this rate. But you find that maybe in May, the actual rate is actually higher or lower compared to what you predicted. Things are not moving in the direction you predicted. And you will find they asking you the justification of the measuring basis risk. Why would you need to measure basis risk? So those ones, maybe we'll discuss them going forward. But it's something that is a bit common as well in terms of theory. Why would you need to measure the basis risk? Justification of the basis risk. Okay. Another disadvantage, you may talk about the margin requirements. As I said, you may need to pay some margins. So these margin requirements, these are always daily. You need to keep on monitoring what is happening. So it requires daily margin adjustments. That is mark to market. When you hear that word, mark to market. So you keep monitoring how the market is moving. And maybe if the market is moving in different direction, you may be required to deposit some money. If the market is moving in a favorable position, you may be receiving some money. So here, it's something that you need also to know. And this one affects your cash flow. This may affect your cash flow. If you find that you're the one to pay, then it means that your cash flow may be affected. And because of its standardization, the standardized contracts, because you find that they are quoted, the features is quoted, let's say $500 or euros. And because of that, you may find that the amount you want to hedge is not exactly equal to the number of contracts. So the amount to be hedged, the notional amounts, and the maturity dates, the notional amounts, and the maturity date, may not exactly match the firm's exposure. You saw that sometimes you get the amount, to be hedged. You divide by the standard amount or the contract size. Then you realize that you're getting a decimal point. What does that one mean? It means that you cannot exactly hedge according to the amount you want. Because of those decimal points. You may find that the available features may not cover the amount to be hedged. Okay, and that one exposes to other risks. Maybe if you have not entered into forward contract, then that balance, that 0 point something will have an impact on your cash flows. You will find that also sometimes examiners told you to use forward contract in a scenario where the features contract have not covered all the money. It's one of the disadvantage. And because here you are looking at the standard features, March, June, September. What if you just imagine you want to hedge? Okay, you are planning to do you're planning your transaction is happening in July, you will be required to use the contract of what? The contract of September. It doesn't exactly really match because the price of July may not be actually the same as that one of September. It's one of the disadvantages that because these are standardized contracts, you will have to go with what is in the market, but it may not actually match with what you want. Okay. So those are the things you really need to master. You really need to master things related to regulatory requirements. Regulatory requirements may also affect you. Firms may face restrictions or reporting requirements when using exchange-traded derivatives. You need to apply those standards. You need to be very, very key. Of course, here there is always complex accounting. When you're dealing with these things of features, you know that standard IFRS 9 is not for everyone. Is not for everyone. So also that point of complex accounting, how will you account for those transactions? It's something that is not easy for everyone. So it involves complex. It requires specialized accounting treatment and documentation for hedge qualification. You know the hedge. When you're talking about IS 32, that IS 32 has component of hedge accounting. It's not really easy for not everyone knows how to handle this standard. So also it's one of the way you can explain your demerit. Among others, requires the expertise. This is the point that always cuts across. Requires expertise. Expertise. Maybe it depends on how you explain, because this point may as well be here. If it is complex accounting, so it means that you need the expertise to handle. Among others, guys, among others, as you may search, But just me, I wanted to give you highlight. Maybe another point is that the limited long-term coverage, because what is in the market covers almost 1 year. What if you want to hedge? What if you want to hedge for something that covers 2 years? So here it may be hard for you. So it is unsuitable. For long-term projects. You may want to hedge in issues related to more than 1 year, and you cannot get something to cover you. Someone had a question. Go ahead.
Yeah, I was just asking about the margin requirements. I don't know, I'm not understanding it.
Margin requirements. Here you are looking at, you be monitoring the market every day, daily. The price keeps on changing. So, because the price keeps on changing, sometimes you find that you're the one gaining, or if the market is not moving in the good direction, you're the one to deposit. The one what we call the market comes in there. That you are going to keep on monitoring how the market moves. If it is moving in a favorable position, you're the one gaining. If it is moving in an unfavorable position, you're the one to deposit, to compensate. I don't know whether it is making sense to you.
Yeah.
Yes. Whether it is making sense to you. But that's basically the margins. That's basically the margin, that you keep on monitoring how the market moves. You keep on monitoring how the market moves. If it is moving in a favorable position, then you gain. Then you may compensate if it is moving in an unfavorable condition. Okay. All right, so let's look at the computation part, but colleagues master. Master the theory. Master the theory very well. In your free time, check through these questions and see what was there. The theory. The theory. Check there. The theory is going to help us to pass this paper. So, so now switch to the computer May 2020, May 2024. We are going to discuss May 2024. The questions about derivatives, they don't take a lot of time. So when you look at May 2020, when you look at May 2020, I don't want to first go into a lot of details. I will explain everything as we discuss. But May 2024, this is what I was saying. Explain the concept of what? Basis risk. You explain the concept of basis risk and justify the need for its measurement in organizations like VUL. Okay, then part B, you estimate the net cost. Estimate the net cost and the resulting effective interest rates of the futures hedge if interest rates fluctuate by 2%. Now, colleagues, if they say that if the interest rate fluctuate by 2%, always know that you don't know which kind of fluctuation. Is it going to be an increase or a decrease? So if they say that if interest rate fluctuate by 2, it means that you will need to look at two sides. In a scenario where the interest rate decrease by 2, and in a scenario where the interest rate increase by 2, because you don't know which kind of fluctuation. Are we together?
Yes. Yes.
Because they may specify that you compute the net cost or the effect interest rate of the futures if the interest rate increase by 2. That is specific. That if the interest rate increase by 2, that is specific. You look at only the increase. But if they say that if the interest rates fluctuate by 2, you must look at two sides. When the interest rate falls by 2 or increase by 2. Okay, so then part C, you discuss the arguments for and against the use of swaptions. This is theory. This is theory that you need to master. This is theory that you need to master. 10 marks. Okay, but for now I don't need to talk about. I will talk about the swaps, swaptions later, next time. For now I am going to handle part B. Why do you need to measure basis risk? Why would you need to measure basis risk? Why would you need to measure basis risk? I have already explained what is basis risk. Why would you need to measure? Why would you need to measure? Have you already searched about that? I have already talked about the basis risk, explain the concept. So basis risk is this one. Basis risk is basically this one. Basis risk, basis risk, basis risk is the risk that the value is the risk that the value of a hedge or a derivative position will not move in perfect correlation with the asset being hedged. That is basis risk. For justifications, I was almost going to say that you go and read. Can you go and read or we discuss? Now, this basis risk, guys, it will always happen because of things related to like the characteristics of the hedge instrument. Hedge instrument. It may be as well as the hedging instrument and the underlying asset. The hedging instrument then also talk about it could be the maturity mismatch. Things related to speculation. Things related to market disruptions. Because of these things, you find that there is mismatch. There is what you predicted mismatch. How is this? What is the spelling of mismatch? Mismatches. So you may find that what you predicted, because as I explained, this basis risk, you are looking at basically the what? You are looking at basically the futures price and the actual price. So the futures price may be not really reflecting the actual price because of these things, because of issues related to the kind of instrument, the maturity period. For example, as I said, what is available is the one of September, but you are hedging something that is going to happen in July. So there is mismatch there. And of course, really the price may not be reflecting. Yes, you are going to use September futures, but technically there is no relationship. So because of those things, there is always that risk. And justification is that one, the justification. Now, justification, you may look at, let's say, why would you need to measure? Why would you need to measure the basis risk? You may look at the, you may need to know, you may need to have the clear information. The clear communication. The clear communication with the stakeholders. It provides stakeholders with valuable insights. Then it will help you to develop. It enables an entity enables an entity to develop and implement effective risk management strategies. Just what does this one mean? Look at a scenario where for example, your number of contracts are not matching with the contract size. Like as I said, when you get the average, let's say when you get the amount to be hedged divided by the contract size, you realize that there is a difference. And now, if you realize that there is a difference, you predict something. And if you realize that there is your amount to be hedged will not be covered by the contract size, then you need to develop other strategies. How are you going to handle the overhedged amount? How are you going to handle this, the overhedged amount? Now you develop the risk management strategy. For example, you may say that now to work on this overhedged amount, we may also need the forward the forward contract that can help us to mitigate this risk on the overhedged amount. So those are the things that you need to know. Also, it may also enable you to identify areas of vulnerability. It will also help you to, in terms of financial planning. When you measure, you will be in a position to plan accordingly. You plan in terms of how it will affect your cash flows. Because once you know that, it will also help you to predict accordingly how it can affect your cash flows or your profitability. And now you can come up with, of course, this one will help you in terms of budgeting, okay? Help you in terms of financial planning and budgeting. Maybe you can also add this in terms of planning and budgeting. How that risk may affect your cash flows or how it will affect your profits. Guys, you'll add other points. Try search and add other. Come up with like 6 for the computation part. Let's handle the computation part. So part B, we are to estimate the net cost and the resulting effective interest rates of the futures hedge if the interest rates fluctuate by 2%. What are we given? What are we given here? We are told that VUL was incorporated in 2001 and became listed on Uganda Securities Exchange on 1st January 2015. At its recent board meeting, it was resolved that the company increases its regional presence by establishing 2 branches in western and northern Uganda. The proposed regional expansion will be financed by term loan of 22,500 million at a prime lending rate plus, are you seeing this? At a prime lending rate plus what? Plus 100 basis points. Something that you need to know. To be acquired from Trust Commercial Bank on 1st August 2024. the date on which you're going to acquire the loan matters a lot. The date matters, the date matters a lot. The date matters a lot. Okay? And free repayable on 28th February 2025. That is repayment what? Repayment date. TCB's prime lending rate is currently, so you have the current rate, the current prime lending rate. Something that you need to know. Currently, that is the what? That is the rate. But you guys can hear me, because I need we move together. We must move together. Confirm whether you can hear me.
Yes, we do.
Yes.
Okay. Aware of the current increase in the market risk, particularly driven by the rising foreign exchange rates and inflation, management is convinced that a lot of uncertainty exists in the financial markets. A recent survey by economists indicated that the interest rates are expected to increase in the nearby future, in line with at 12 months. Okay. Consequently, the treasury manager at VUL has suggested that it would be prudent for the company to consider hedging against the likely movements in interest rate using interest rate futures. Okay, you have been provided with the information on the futures and options to assist in your evaluation. So you have the 3-month shillings futures. This is the contract size. You have the contract size, you have the tick size, you have the tick value. Then you have the June futures, September futures, and December futures. Assume that today, this word is very, very key. Assume that today is 1st March. Sorry, assume that today is 1st May 2024. And the settlement for the futures is at the end of the month. So how would you handle part B? It's a very, very, very good question. It's a very, very good question. It's a very, very good question. Okay, so how do we start? How can we start? Now, because I don't want to just know, you may be dealing with a question where the firm is an investor or a borrower. Now, here, a company is a borrower because they are looking forward to borrow. They want to get term loan, which will be repaid at a future time. So what will happen is that you, the person who is borrowing, you go to the market and buy suitable what? Buy suitable features. You go to the market and buy suitable features. You as a borrower, you are hedging against any rise in the interest rates. And now from the question that we are given, we have only 3 features in the market. We have only 3 features. The one of June, September, and what? And December. These are the features that we have in the market. Now, the prices quoted here will always be your opening, features price. The price is quoted. These ones will always be your opening features price. But of course, you will need to know. Out of these features, which one is suitable for my case? Which one is suitable for my case? It's something that you really need to master. Which one is suitable for your case? Which one is suitable for your case? And what did we say? Which contract is always suitable? If you are planning to borrow, always know that the contract, that the features that is suitable will always be that one after the one to expire immediately after the transaction date. The one to expire fast. The one to expire fast after transaction date. Which one will expire fast? And what is our transaction date? Now, the transaction date will always be the date on which you're borrowing, the borrowing date. When are you borrowing or when are you investing? That will be your transaction date. Something that you must know. Something that you must know. When is your transaction date? Because when we are dealing with features, you need dates. The dates you're talking about here are 4. The dates. 1, you need the date now. What is the now date? You need the date of transaction, because in the question you may have all those things, the date of transaction. You may need the date of full repayment. Then you may need the expiry date of the features contract. Those are 4 dates. Those are 4 dates that you may be dealing with in the scenario. But you will need to know now which one is applicable on the step you're handling. Which one is applicable? If you are looking for the opening features price, the opening features price will always be that price quoted on the features contract. And what will be the features contract? The contract to expire fast. The one to expire fast after the transaction date. And what is the transaction date? When are you actually borrowing? In this question, when are we actually borrowing? This question, when are we
We are borrowing on 1st of August 2024.
Now, the now date is 1st May 2024. The now date is May 2024, but it doesn't mean that you're borrowing on this date. You are borrowing on on 1st August 2024. So because transaction date, what will be your opening? Which contract are you going to use?
The one of September.
Which contract? The September contract. Let me hope, guys, let me hope everyone is following. We need to move together, because we don't have time to keep on repeating these things. So let's move together. I can over explain, but let's move together. If you cannot identify the contract, the opening features price, know that everything will be wrong. First, know what is the transaction date. That is, after knowing the transaction date, when are you actually borrowing? That will be the transaction date. After knowing the transaction date, immediately ask yourself, from the features given here, June, September, December, which one is going to expire first after the transaction date? This one already has expired. By the time you transact, this one has already expired. This one has already expired. So the next one to expire after the transaction date is September. It's the one to expire first. So it means that this company will need to enter into the September futures contract. Okay? And the moment you enter into September futures contract, automatically this one will be your opening futures price. Okay? Let me hope that one is clear now. So let's write something. Let's write something now. Let's write something. So what we can do, I am going to say that since of course you don't need to cram these words. You don't need to cram these words. For you, you may just write in your own understanding. But let me just say, since VUL is required to borrow, is required to borrow on 1st August 2020, what 2024. We'll need to enter into September futures contract. September futures contract to hedge against the rise. Because you are a borrower, your worry is about the interest rate increasing. Okay, so here we are to hedge against the rise in the interest rates. Are we together, guys? Are we together?
Yes, we are.
Okay. If you are an investor, your worry is about the interest rate falling. So you hedge against the fall. Here you don't put rise. You hedge against the what? The fall in the interest rate. But here you are a borrower. So your worry is about the interest rate increasing. Okay. So that is the first point. Now, after putting this, you know that you are entering into September futures contract. What does that one mean? It means that now, since VUL, okay, since VUL will be borrowing, it will enter. Is it good to use it? It will enter, or they will enter. Which one is suitable? You guys who studied in good schools, which one is good to use here? Will enter.
It,
Eh?
it will.
It will enter into a contract to pay interest at now you enter into a contract to pay interest at what? Now you look at the opening, the September one, the September one is this one. But this one, what is quoted here, these are prices. These are prices, not percentage. These are prices, not percentage. So you convert from a price to percentage. How do you convert from a price to percentage? You get 100. So you can put in bracket 100 minus what? 84 point what? 84.94. What do you get in terms of percentage? That one will be what?
15.06.
15.06%. So you enter into a contract to pay interest at this. So that is your opening. In short, know that what you're starting with is the opening features price. As I said, don't cram what I am putting here. Just know how you can phrase in your own words. You're entering into September futures contract, and because you're entering into September futures contract, the opening futures price, the one you will need to pay, you will need to pay at this as your opening futures price. Now, after knowing that, what does that one mean? The next step, you simply need to know the number of contracts. Just master the steps. You need to borrow on 1st August 2024. That is your transaction date. And now, what is the futures contract expire first? That is September. So I will need to enter into September futures contract to hedge against my worry. That is rise in interest rates. And because you have entered into September futures contract, then what are you going to pay? What will be your opening futures price or the opening futures rate? Okay, that is 15.06%. After knowing that, other things will be easy. And the moment you fail on the first step, all these things will be hard for you. You will not pass. There is no miracle here. So pay attention as you start. So how do you get the number of contracts? The number of contracts, we simply get the loan amount, then you divide by the contract size. You divide by the contract size, then times what? The loan term or the loan period, the loan period divided by the standard or the contract duration. The standard term of the features. So that's what you do. So it means that here, what am I going to do? What is my loan amount? Here? It is 22,500 million divided by what is the contract size? What is the features contract size? The one given, the one quoted. It's 175 million. That is the one quoted. Each contract is 175. Each contract is 175 million. Now, colleagues, pay also attention in terms of the prices. Are all amounts in the same currency or not? Because you may find that in our paper, what what you're hedging, the currency is different from the what? From the futures contract currency. And when you're getting the number of contracts, the currency must be the same. So the question would be, which one will you translate? You translate the one you're going to hedge. You don't translate the contract size currency. No, you translate what you're going to hedge, the amount to be hedged. So that's what you translate that amount into the currency of the contract size. If you meet that, don't say that you have never heard about it. Okay, but here you don't need it to translate. All amounts are in the same currency. So times the, what is the loan period? The loan period. The loan period. What is the loan period? You're going to count how many months to pay. Count from the transaction date up to the repayment date. The transaction date was
7 months.
And you're paying on 28th Feb. So use your fingers. August is inclusive and Feb is inclusive. So count. I normally count from that transaction date up to the year end. So that is August, September, October, November, December. Those are 5 months. I add 2. So those are 7. Those are 7 months. 7 months. So yeah, I'm going to say 7. Use fingers when you're in an exam. So here it's 7 out of what? 7 out of what is the contract duration? Each contract takes how many months? Only 3. Only 3. Okay. So when you do all this, what will be your number of contracts? What will be your number of contracts?
300.
Pardon?
300 contracts.
There is no decimal points, eh?
No, just 300.
Oh, so when you get this, it means that basically the whole amount is covered. You can easily hedge all your amount using futures contract. But if you get like 300 point something, it means that you cannot hedge everything using futures contract. So the balance, the overhedge or the underhedge may be covered using other means like forward contract. Okay, but for now, let's just move on. After getting the number of contracts, what is the next step? What is the next step? Before we move on, take note that you only add this loan period over contract duration if you're dealing with interest rate. If you're dealing with currency, don't add these things of loan period over contract. You just get the amount to be hedged divided by the contract size. Okay.
Abel.
Yes, please.
You said if we get if you had gotten like 300 point something, you said it would mean what?
Now, always look at this. Sometimes you get 300 point, let's say 300.5, let's say as 876 contracts. What does that one mean? It basically means you are going to get this 300 if you want to prove, because there is nothing like 300 points, these contracts. Are you saying that? You either round off or don't round off. But most times we don't round off. Examiner will tell you maybe round off to, sometimes the examiner can tell you round up or round down, depending on the words he has used. Now, if it means that you don't have 301 contracts, you just have 300.376. So if you get 300 contracts times the contract size, that is 175 million, what do you get? Just I want to explain what I was telling you. What do you get? It means that your features can cover only 300 contracts. Okay, what do you get?
You get 50 to 500.
Pardon?
50 to 500.
50 to 500 million. That's what you get.
Yes. 300 times 175.
Okay. Then times 3 out of 7, what do you get? Rather 7 out of 3.
You get 122, 500.
122, 500 million. So in total, what you're supposed to hedge is how much? You're supposed to hedge 22, 500. Are you seeing?
This one is 122. 122, 500. 122, 500.
122, 122, 500. What are we doing? Just a minute. 52 times 175. 300 times 175. You get that. Then times 3 out of 7. Okay. My calculator tekora. Simanyi ono. Nja kuyitawo ntya. Okay. Okay. What I wanted to, you get this amount is above this. When you, this amount is above this. What was our initial amount? What was our initial amount? It was this one, eh?
Yeah, the initial amount was, initial amount is 22,500.
We want to know. When you get 3 out of 7, what do you get? 3 out of 7.
3 out of 7. You get 0.428. 0.43
times this figure.
times 52.
Because I
You get
saw that.
22,500.
You get what? 22, eh?
22,500.
You get 22,500. Like what we had initially, eh? You get, eh? So it means that like what we have calculated here, these contracts can cover the amount, can cover your amount. So it means that your features contract can be covered, can cover your amount to be hedged. But we are looking at a scenario where you have something like 0. So it means that the 0.676 times, let's say, because this is assumption, times the contract size. Okay. Just assume initially the amount was, let's say, because assume the amount was, let's say, 30. And after getting 300.676, you're getting this. So you get the difference between these two. You get the difference between, for you, don't, as you multiply, don't consider this. Simply consider the 300 that will be here, times the contract size, times now you make the reciprocal of your debts, 3 out of 7. Then the answer you get here, compare it with the amount to be hedged. Then the difference, it will show you that it is overhedged or under. It is overhedged or underhedged. The difference you have between these two figures, what is that difference? That is what? That is 800. 800. What is that
It is
difference?
8,000.
8,000 million. Now, this difference here that you have, examiner can say that you hedge this using futures contract, rather using forward contract. And if you use forward contract, what do? You get that 8,000 million times. Of course, you look at the futures contract. It could be like 3 months futures, 3 months. What is the exchange rate of the next 3 months? So examiner will give you the way we be handling using forward contract, money market, lead payment, like it will be the same. So you look at the 3 month, the 3 month exchange rate. I saw this in rather in ACCA. So examiner can take that side. So as you use features, you concentrate on this. What can you actually buy? What can you actually hedge using futures contract? This is the amount that you can hedge using futures contract. Then the difference between these two can be hedged using the forward contract. But if examiner has not stated, don't force yourself to do this. Just that it has not been examined in CPA papers, but I saw it in ACCA, those advanced financial management papers. So you may find that there is part B where examiner is saying that you hedge the remaining balance using forward contract. So that's how you will handle. You focus on the difference between these two and hedge it using forward contract. I don't know whether you have picked something.
Yes.
I don't know whether you have picked something, but you know these things, because for us we normally practice CPA papers only, past papers, and it is just also dangerous. We are not exposed to other things. We normally discuss only CPA papers. The moment the examiner asks something that has never been examined, we are off. We are off. So it is good to be exposed with different questions. Okay, but if examiner has not stated anything related to, let's say that you hedge the balance using forward contract, focus, just you may round off or not round off. Okay. Okay, now here we have 300 contracts. The next step, time is taking up. The next step is looking at the closing futures price. The closing futures price. The closing futures price. But of course, we normally use rate. At the end, we put it in terms of rate. Now, how do you get the closing? You follow the steps. This was step 1. This is like step 1. This is like step 1. This is like step 2. But in an exam, don't put these steps, just answer. This is like step 2. Now you are on step 3. You are on step 3. This is step 3. I want the closing futures price. How do I get this? I look at now, as you get the closing futures price, remember you had the opening. This is the opening. This is the opening futures. This is the opening futures price. Now we need the closing futures price. And what is this closing futures price? This is basically the price on the transaction date. What is the price of the futures on the transaction date? The futures price on the transaction date, that is on 1st August 2025. Please master, rather 2024. This is the 1st August 2024. Then the opening futures price is the price on the price quoted on the contract you entered into. You entered into September contract. So if you entered into September contract, what is the price quoted there? That will be your opening futures. Then how can I get the closing futures price on the transaction date? On the transaction date. This is the transaction date, if you want to record in your summary. Transaction date, just to avoid making errors. So how do I get this? How do I get this? I simply get the base rate. The base rate, that is the rate, the rate now. What is the rate now? The current rate. Currently, what is the rate? What is the interest rate? As of now, today, what is the rate? Then I subtract. Here, let me just, I simply add the unexpired basis. If you get expired basis and it is negative, you subtract. Now, how will you get an expired basis? Because first of all, what is the base rate now? Before we go to an expired, what is the base rate now? What is the base rate?
I think it is the 15.06, the opening features price.
No, that is the CRB.
The prime rending, the current, the features price. Currently, the price is, the rate is this. Do you agree? Currently,
Yes.
the rate is this. Currently, sometimes this base rate may be RIBO. They can use prime lending rate. They can use central bank rate. So whatever you meet in an exam, they can say RIBO. They can say, they call it RIBO or RIBO. The CBR, central bank rate, whatever it is stated in an exam. So for you, focus on currently now, the currently now, what is the rate? So the rate is the rate is what? What we saw that the rate is 16,
14.5.
14.5. Okay. Okay. Then what will be the unexpired, the expired basis? How do you get the expired basis? To get the expired basis, you simply get the expired basis, you simply get
The total basis.
A over B times what? Times the total times the total basis. What is A? What is B? A, just that sometimes I don't normally like to use the formulas because they can confuse when you're not familiar with formulas. But simply know that A is the period that has not yet expired. A is the date between transaction date and the date on which your futures contract will expire. How can I summarize it? The expiry date of futures contract. Does it make sense? The date between transaction date and the expiry date of the futures contract. What is the contract date? What is the transaction date? We want to know, okay, from now to the date when our contract will expire, what is that period? Remember the transaction date, like now, the transaction date is what? 1st August. 1st August 2020, what? 1st August 2024. Then what is the expiry date of the futures contract? This contract, this September contract. September contract will expire on which date? That is 30th September 2024. So what is the period in between there? How many months? So that is August and September. These are only 2. Then B. What is B? B is the date. It's okay. Period. I cannot use the date. Period between. Period between now. Okay. Between the transaction date. So here I'm going to say the period between. The period between now date and the expiry date of futures of the future contract. So the now date is what? The now date is 1st what? 1st May 2024. And the expiry date of the contract, the expiry date is what? This is what? This is 30th September 2024. So if you can master this thing, it will not be hard for you guys. So how long? What is that period? How many months?
5 months.
5 months. Here these are 2. So it means that now here you have A over B. Then do you have total basis? How do you get total basis? To get total basis, you simply get the opening futures price. The opening futures price. Then subtract the current price. This will be what? Opening futures rate. Okay, since you're dealing with rate, I just put the rate. The opening one, we saw that it is 15.06. Then currently, what is the rate?
14.5.
These are rates. At 14 point what? 14.5. 14.5. So what do you get?
We get a 0.56.
Here you get 0.5, 0.556. Perfect. Perfect. So your unexpired basis, your unexpired basis will be what? 2 out of 5 times 0.56. What do you get? What do you get? What do you get? Put some speed, guys. Time is taking us.
We get a 0.224.
0.224%. Okay. Any question here? Any question here?
Yes. Abel, how did we get the 5?
How do we get the 5?
Mm.
Look at B. That is B. The period between now date. What is today? What is today's date? Now. Assume that today is 1st May 2020. So count from the now date up to the expiry date of the what? Of the future contract. Remember, your contract will end on 30th what? September. So count the period between now up to what? September. Is it clear?
Yes, thank you.
So A, always know that A is basically the period that has not yet expired. Unexpired, this is the period not yet expired. The period not yet expired. So the period that is not yet expired is the period between the transaction date and the date on which your contract will expire. All right, so once you get your basis, your unexpired basis, you get the closing features. Remember, as you get the closing features, guys, you are getting the closing features. That is that the transaction date. That's what we said. Other transaction date. But they told us, when you look at what they told us that the rates are likely to fluctuate by what? By 2%. Are we together? The other rate, our rate is likely to fluctuate by what? By 2%. Our rate is likely to fluctuate by 2%. Which rate? The base rate, this one. Do you agree? This one is likely to fluctuate by 2%. So as you get that, as you get the closing features price or the closing features rate, it means that you need to look at a scenario where the rate has increased by 2 or decreased by 2. So there is a way you can always maybe have it in a table format. You can have it in a table format. Just to summarize, here you can say when the interest rate increase, when the interest rate increase by 2%, when the interest rate increase by 2%, and also look at the scenario when the interest rate fall by what? By 2%. So you are looking at the closing features price, closing features rate, when the interest rate increase, because they told us fluctuate. So if they say fluctuate, it can increase or fall. So Here you will need to look at the base rate. What will be the base rate? The prime lending rate as at 1st August 2020 what? 2024. So the prime lending rate as at this date, because we are saying that currently the base rate is this one. That is currently. But we need the one as at what? Okay. Maybe to make it, okay. 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 As we are getting the one as at this date, we are going to get the other one of 14.5. Then plus, because this one is going to increase by 2 plus this. What do you get? This will be
16.5.
16.5.
16.5. Let me open your mind. You're not saying that it is becoming hard. It is easy. When you practice, it will become very easy. Now, when the interest rate fall, remember it was 14 point what? 14.5. So you reduce this by what? By 2. So you remain with what?
12.5.
Pardon? That is
12.5.
12.5.
12.5. Perfect. Okay, so that's what we have. That's what we have. Remember, you get the base rate. You get the base rate. Maybe here I may confuse those who are copying that you said here currently. So here, first get just adjust and put here on this date. May confuse you, but this is the one currently. Okay. So we say that as you get the closing features price, you get the base rate. The base rate. So we have the base rate now. That is the base rate on transaction date. Then we add an expired basis. An expired basis is what? Already we have 0.224. 224. This one is constant. It will not change, whether the rate changes or not. So in total, what will be your closing features? In total, when you add here, what do you get?
In the first one, it will be 16.7.
Closing features will be
16.7.
Only?
I rounded off.
Okay, this is 7%. Then here,
Okay.
when you add, remember you're adding,
There you get it 12.7.
Here you get 12.7. So once you have the closing features rate, other things become very, very easy. So I don't know whether you have a question here. If you have a question, you ask. You have a question, you ask. The problem is how to get closing features. Once you master how to get closing features, then other things will be really very, very easy. So once you have this, you can close now. With the last step, the second trust here, we are looking at step 3. Step 4. Step 4. We closing the feature contract. You close. And when you close, when you're closing, basically you need to see whether you're gaining or or benefiting. So when you're crossing, always look at two sides separate. Look at two sides separate. Now, you will start with in a scenario where when the interest rate increase by 2%. If it increase by 2%, the now rate is what? From by 2%, it will be 16.5.
7.
Okay, if the interest rate
16.7.
increase by that, pardon?
16.7.
16 point what?
7.
It's 0.7.
Yeah.
Yeah. Then here it means that it is wrong as well. Eh? How is it 0.7? Huh? How are you getting 0.7? Are you called the rate? How are you getting what? 0.7? Remember, initially it was 14.5. Rita, are you on?
It's okay. I was looking at the closing futures. It's
No. Don't look at that. Eh? Don't look at that. When the interest rate increase by 2% to 16.5, what will happen is that you will have the opening features rate. You open it by what? That was the contract. The contract to pay interest. So you opened you opened with what? You opened with what was the rate? 15.05, isn't it? You opened with what? That one. So you are going to cross the closing features. The closing features rate. That is now you cross by what? If you opened by, you enter the contract to pay. Now you cross with what? This will be the contract to do what? To receive interest. So if you opened, let me open, it's making sense to you guys. So you opened, that was the contract to pay interest at this. Then here you're closing with a contract to receive interest at what? You're receiving interest at this rate. You're receiving interest at the closing rate, 16 point what? 16.7%. 16.7%. So the question is, are you making a gain or a loss or no? Features. I want to hear from.
It's a gain.
So here we are making a gain.
A gain.
A gain or no? Let me hope all of you agree that it's a gain. Because you paid here, you had a contract to pay this, but now you're closing, you're receiving now the interest at this rate. So ideally you're making a gain of what rate? 1 point what?
1.65.
1.65%. So once you have a gain, if you realize that you're receiving at a lower rate, that is a loss on futures. That is a loss on futures. But here we have a gain. Now, once you have that, I'll go ahead and get the net outcome. That is the last step. The last step. Step 5. But still, when you're looking at this, when the interest when the interest rate increased by 2%, choosing you. Okay, so the net outcome, you simply look at the actual interest cost that you're supposed to pay. What is the actual interest you're supposed to pay? You're supposed to pay, when you look at the question, you received the loan, but they told you that this loan is at a prime lending rate plus what? The interest rate is the prime lending rate plus 100 basis points. 100 basis points is equal to what in terms of percentage? So here you get the prime lending rate now, which is 16.5. The prime lending rate now, the transaction date. That is a transaction date. Then add the basis, which is 1%. Get that figure divided by 100. You get 1%. If you have 50 basis points, you get 50 divided by 100. Okay. So you get the prime lending rate now, at the transaction date plus the basis. What do you get?
That is 17.5.
17.5%. Then also look at the gain on no.
I beg your 1%. The basis point. How have you gotten the 1%?
Oh, they gave us 100 basis points. So to convert from this percentage, always get 100 divided by the one you are given, then divide by 100. Divided by 100. That is 1. If you're given 30, get 30 divided by 100. If you're given 50, get 50 divided by 100. The answer you get, put it in percentage. Here you get 0. What? This will be like 0.5, eh? So it will be 0.5%. Is it clear, Maureen? Are you called Maureen? Maureen?
It's clear.
Is it clear?
It's clear, thank you.
All right. So gain on features is what? It is 1.65%. So what do you get? The answer you get will be your effective interest rate, which is what? Now, guys, don't make a mistake. Remember, this is a cost. Put this one in a bracket. This is a cost. Don't make a mistake. This is a cost. This is a gain. This is the gain. So if you have a gain, it reduces on what you are supposed to pay. So you get what? The difference between these
Is 15.85.
15.85%. So that is your effective interest rate. So once you get the effective interest rate, once you get your effective interest rate, you can get the net cost. The net cost. So the net cost will be the effective interest rate, times the loan amount then times the loan period over 12. The shortcut. So here it will be 15.85% times the loan amount, which was 500 million times 7 out of 12. So the net interest, the net cost in terms of amount will be shillings what? So that is your net effect cost, and that is the final answer. Now, you are not done, because you were looking at when the interest rate increased by 2%. Also look at the scenario when the interest rate decreases by 2%. But I want also to give you another approach. I don't want when you meet these things, they confuse you, like the way we have determined before we go to the last step. Just pay at, let's clear this. We are almost done, because I don't want to say, this approach. Sometimes you may meet some people doing it like this. Net outcome. For net outcome, you get the interest cost. And the net interest cost, you get, now you get cost in terms of amount, direct. So you get this one, you get, it means that you have 16.5% plus 1%. Then the answer you get multiplied by the loan amount, that is 22,500 million, then times the repayment, the repayment period 5 out of 2. So the answer you get here will be in terms of amount. So here you will be looking for the net cost direct. Okay, so here what do you get? After that, you add, remember what you get will be in terms of the negative. This will be a cost. Okay, so tell me what you have. Then you add the gain on features in terms of amount. That will be what was our gain on features? 1.65%. And then times the the contract size. What was our contract size? 175. 175 million. Then times what was the features term? 3 out of 12. Features term, the contract period.
Duration.
How many contracts?
300.
300. Then you get the answer. What do you get? Then the answer you get directly, the answer will be the net cost. This will be the net cost. So here, what do you have? The first one?
2297.
2297 million, eh?
Yes.
Then here, what do you have?
217.
217 million. So when you get negative this plus this, what do you get?
2080.
2080, like this, eh?
Yeah.
So you see that you're getting the same answer.
I had used this
You're
one.
getting
The
the
second
same
approach.
answer. So
I had used the second approach.
which approach is easy?
This one, the second one.
The second one.
Yeah.
So once you get the net cost using this approach, you go ahead and get effective interest rate. Effective interest rate will be what? Will be the net cost of
Look at the loan
loan
amount
amount,
times the
then
reciprocal.
times the reciprocal. That is 12 out of 5. So here it will be
It is
2
7.
million divided by 225 of this, then times this. Do you get the same answer? The effective interest rate?
15.85.
15
But
point.
the what? It is 12 out of 7, not out of 5.
It is what? 7, eh?
Yeah.
12 out of what? 12 out of 7. We are making, what will this? Did you multiply by 5 out of this? That's what you did?
No, I did by 7 out of 12. 7 out of 12.
This is wrong, eh? 7 out of 12.
12.
So yeah, reciprocal 12 out of 7. So you must be getting the same answer like this, eh?
It is the
You
same.
get, so which approach is easy? The first one, second?
The second one.
Second one is easy. Second
Yes.
one takes time.
It doesn't.
But Aura is, but examiner is taking this approach. Why would you compute the number of contracts and you don't use them anywhere? So I think that's why this second approach may be applicable. Because you see this first one, you're not using number of contracts anywhere, isn't it? This one. The first approach, you're not using number of contracts anywhere. But here you put into consideration those contracts. So you use the same approach when the interest rate fall by 2%. When the interest rate fall by 2%, what will be your net outcome? Let's use this approach. Let's use this approach. When the interest rate fall by, okay, before we go to that, you need first to know, when the interest rate fall by 2%, do you have a gain or a loss? So compare. When the interest rate fall by 2%, do we have a gain or a loss? So here,
No.
the opening features will remain the same, but the closing is different. What is the closing? Our closing was what? From the computation, we had the closing features
12.
here. The closing feature was what?
12.7.
Was 12.27.
12.7.
12.7. So
No,
yeah,
12.7.
12.7. The difference is what? Are you gaining or making a loss? Are you gaining or it's a loss?
It's a loss.
This is a loss. You're paying interest that you paid at this, now you're receiving at this. So it's a loss on futures. And that loss is of what percent? Put some speed, guys. Time.
2.35.
2.335. Okay, so that is the loss. Once you get the loss, the next step is to look at the net outcome. So net outcome, let me just copy this, then I make some few adjustments. The net outcome, I make some few adjustments. Just a minute. Of course, here the net interest cost will be, now here it will be what? If the rate decrease by 2%, the prime lending rate is what? On 1st October, 1st August,
12.5.
it is 12.5, 12.5. This is 12.0. Oh, we are here. This is 12.5 plus the basis point, which is 1%. Other things remain the same. Then here, this is a loss. This is add the loss. The loss is what? 2.3, 2.35. Other things remain the same. So here, what do you get? This one will change. What do you get here? 13.5% times 17. So this is in bracket 17.
1772.
1772. Eh?
Yes. Yes.
Then here as well it will be negative because it's a loss. 2.35%. Don't forget this percentage. So you divide by 100. This one divided by 100 times this times 3 out of 12 times 300. What do you get?
308.
308.
8.
Finally.
2080.
Pardon? 3.
2080.
Like what we had.
2080.
2080. So it must be the same, like what we had here. It must be the same. When you get different answer, no, you're wrong. You know you're wrong. So once you get the net cost, go ahead and get the effective interest rate, which is like this. So you're done with the number. Just master the steps. These steps will not change. These steps will not change. These steps will not change. So you have answered part B. That's all. And you see, we are taking time just because it is a discussion, but this is something that you can do in just 15 minutes. In an exam, this is something you can just do in 15 minutes. Okay. So you guys, we are done with the interest rate features. The difference is that if you're dealing with the investor, then the difference will be just here. With an investor, you start with an interest to receive. That will be an interest to receive. Your opening features will be an interest to receive. Then the closing will be an interest to pay interest. So that will be the difference. For you, you start with an interest to receive. Then you close with an interest to pay. Are we together, eh?
Yeah.
So then also the wording will depend, since VUL is required to invest on this, we will need to enter into the contract to expire first after the investment date. Hedge against the fall in the interest rates. So since VUL will be investing, it will it will need to enter into a contract to receive interest at, now choose the rate at what? The rate quoted at the rate quoted on your futures contract. And you move on, other things remain the same. Here where you have loan amount, you put investment amount. That is where the difference is. The way you determine the closing features, whether you are borrowing or investing, it is the same. It is the same. Okay, so that's all. I'm done with the interest rate features.